Happy Friday, everybody. Welcome to Real Assets Weekly number 6. Today is May 26th, 2023. Back with me, my co-host, Jimmy Wang. What's up, Jimmy? How are you?
I'm doing great, Turtle. Happy Friday. I'm
Yeah,
wishing you a grateful and restful Memorial Day weekend. It's a great time
absolutely.
to be with your loved ones to reflect on and opine on a lot of things. And here we're talking about finance and real assets, right? We're definitely at we say we've been at an inflection point for a while, but it's a great time to just hit the pause button and
Yeah,
figure out what's next for the rest of the year.
absolutely. A lot going on out there, and specifically in the world of real estate, real assets, publicly traded real estate. I mean, who's better to talk to than our man here, David Auerbach, the Don Corleone of the REIT Mafia?
I thought
That's
that
what
was
I
the
call him.
Renzo. I thought I was the Renzo Gracie of the REIT Mafia.
Yeah, oh yeah, that's what it was. Yeah, yeah. A lot of nicknames. He's the man within REITs. He's the guy you want to know. And so he's the author of the Daily REIT Beat. He puts that out every day. He's a great follow on Twitter. And he's also the one of the proprietors of HAUS ETF. We can talk about that a little bit, which is a proxy for publicly traded housing REITs. So don't know how much we'll talk about that, but we'll definitely that is the case, and so definitely check that HAUS out. With that, happy Friday, guys. David, maybe just because Jimmy and I probably wouldn't do it justice, it's a long CV. Just real briefly for our unfamiliar readers, most of them are viewers. Most of them should be familiar with your work, but if not, tell us just briefly about you, the fish obsession. How did all this come to be?
First of all, it's great to be with you guys. I'm noticing only one of you is using your Twitter handle in our IDs here. Jimmy and I are both not on Twitter brand here with our IDs, so we'll have to fix that for next time.
Gotta fix that.
But it's great to be here on Friday, and I echo everything that Jimmy said. It definitely this weekend gives you time to reflect, appreciate, obviously thank all of our servicemen and women for everything that they do. Yeah, it's the official start to summer, but it's so much more than that, what this holiday and this weekend represents. So um, it is a good time to be with you because we are at a very interesting point in this commercial real estate cycle. But for me, I'm almost a 25-year REIT industry veteran. I've been a REIT institutional trader working at some of the biggest institutional trading desks that specialize in the REIT industry. I also worked for an ETF sell side firm working on trading, relationship building, creating new shares, all that fun stuff when it comes to the world of ETFs. And I happened to find myself at the intersection during COVID when I was approached by a former client to basically run a REIT ETF. And when chatting about how we would differentiate ourselves versus all the other ETF issuers and other REIT ETFs that are on the market, a lot of it comes down to networking, not what you know, but who you know, and having a brain trust. I'm in charge of sales and marketing, and I don't view myself as sales and marketing. I view myself as education. I try to educate everybody about the why of REITs. If our fund is for you, that's great. Let's talk more. If our fund isn't for you, that's great. Let's talk more because I want you to understand the REITs that we interact with every single day. Everybody has a different level of understanding when it comes to the world of REITs. I treat it as a level playing field. Everybody knows kind of nothing because from a lot of our REIT knowledge comes from what we see on TV, we read on Twitter, or see just driving down the street. And I feel that so many investors are misinformed about the why of REITs, especially when we think about what's happening in the world of interest rates. That if you can get somebody to have that aha moment, realizing how much we interact with REIT properties every single day, kind of like what we're doing right now in this Zoom conversation, utilizing, a REIT owned property, then it makes our jobs a whole lot easier. From where you and I sit, we can't control stock prices. We could find opportunities that lie within stock prices, but I have no control over my stock price going up or down today, or any of our constituent stock prices going up or down today. But we can control the narrative. And if I can make you understand again why we're focused on residential, or why you should be focused on 5 to 15% of your portfolio in a broad-based REIT basket, then I've done my job. So that's where I am at this stage. I'm lucky to have, met you guys on Twitter over the past couple of years, hosting Twitter Spaces events and, meeting you guys in person, or one of you guys in person. I hope to meet the second one in person very, very soon. But, I'm very approachable. I love talking about this stuff. I know we're only going to do this for about an hour, but I could sit here and talk about this stuff for 24 hours just because there's so much fun stuff to learn. And then when it comes to fish, I mean, dude, that's just being in the right place at the right time, being a kid, being introduced to music as a teenager, and knowing the right people. And now 200 plus shows later, I can't get enough. That's why I wore one of my fish shirts for you today.
I was just about to say, I love your shirt.
Thank you. Just in honor of our conversation today, I brought it in. So.
I love it.
What do you got for me here, Turtle? What do you want to talk about first?
Yeah, so let's jump off here. Here's something to jump off with, and tell me what you guys think about this. So maybe a good thing to starting conversation. HAUS is a real estate investment trust that like the name implies focuses on housing REITs, and I think it's funny. Jimmy and I manage client portfolios and interact with retail investors, and to me it seems like your average retail small business owner, retiree, etc., is over interested in owning real estate. Like it seems like I'm in Southern California, a lot of real estate wealth here. It seems like everybody owns or wants to own real estate, and there's a lot of wealth in real estate. Real estate investment trusts, however, are looked at, paper real estate is looked at more skeptically. It seems like it's just the base case of the investors I don't interact with. So that's, one tidbit. The other thing and then what we've seen in the last year and a half, since Q1 2022, REITs have gotten smoked broadly as an asset class. That's the technical term for it, I think. Private real estate hasn't, right? Private real estate maybe has, depending on what you're looking at exactly, has deteriorated in pockets, 5, 10, 15% potentially, but real estate investment trusts significantly more. And so maybe as a jumping off point, is there a disconnect there, and why? Well, let's just start with that. Do you guys think, I think I know the answer to this, but do you guys think there's potentially a disconnect, potentially an opportunity in buying this orange line here, if we're taking this Morningstar data that Janice put together for gospel? So maybe start with you, David. What do you think about this chart and potentially the opportunity today available in publicly traded REITs versus privately held REITs or privately held real estate generally?
It's a shame we're having this conversation right now and not on June 6th, when I can talk to you more about this, because yes, there is an opportunity that exists. The publicly traded REITs are trading at around a 25% discount to net asset value right now. The private guys are trading at let's say a 10 to 15% premium, maybe a little bit less than that. But the problem is that the private guys are using what we call a stale valuation. They're using a property appraisal number from last year. We don't know at what point of last year, but assume it was, let's say, anywhere from beginning of second quarter till the end of third quarter at some point last year, when everything as a whole is appraised. And again, I know that they regularly roll the appraisal by sector through the calendar year, at least that's what they've said. But I'm using, let's say, the middle of the year as an average on the whole. The world's changed dramatically since June of 2022 to June of 2023. And so you can't value properties. It's not an apples to apples valuation. And thus, yes, there is an opportunity. You will be seeing something coming here very soon that's going to, I think, take advantage of what's happening there. But you talk about the investment in private real estate, you being in Southern California. And remember that, the average Joe and Mary can't technically afford to invest in private real estate. The investment that they put that into is their own home. And we can get into that, but go try to buy a house right now. Forget the fact that housing prices are elevated, but how about taking down a 7+% mortgage? You are underwater no matter how you look at it, because you're paying potentially extra thousands and thousands of dollars a month in interest. So there's all these factors that are kind of leaning up against you when it comes to owning a house right now. And again, that's a separate conversation. But private real estate is geared towards a certain type of investor, whether it's a GP, LP type of fund, investing in a private real estate vehicle, that's geared towards a sophisticated investor, an ultra high net worth investor. The 100-aire, the 1,000-aire is not going to get that. That's geared more towards the millionaire, the 10 millionaire, the billionaire type of audience. So I think number one, it's know your customer. Who are you approaching? What are they investing in? What is the fund that they're going into? And more importantly, how do you even get out of the fund? Because traditionally with a Wall Street stock, you pull up E-Trade, you put your order in, buy or sell, boom, you're filled, you're in or out. With one of these private vehicles, you have to wait for the redemption window to open, the property to change hands, and the GPLP winds itself down. But there has to be some kind of exit strategy. And when you're locked up in some of these vehicles for several years or more, and you may not see your proceeds for many years down the road, that presents its own interesting challenges, especially in an environment like we're dealing with right now, where the market's just been a complete roller coaster and property values have been a roller coaster as well. Jimmy?
Those are some fantastic points, David. And I think a very natural segue is when I think about, for most people, their experience with real estate, their interest in real estate, we all grew up playing Monopoly. Most people just want to be a landlord, collect some type of passive income, and get leverage on their cash flows. Now, for most of us growing up, we've been in this tremendous bull market for interest rates where they've gone lower and cap rates have gone lower and prices have gone higher. And in a prior episode, when I talk about publicly traded REITs and real estate, there's a couple of different factors to consider, right? There's the underlying performance of the asset, there's the machinations and the illiquidity of the private market, and then there's the technical analysis of the equity itself, the volatility characteristics, the factor exposures, and the things that people either like or don't like at different points in time. I think, as Blackstone would like to say, the illiquidity is a feature and not a bug. We'll see how well that works out for their clients. Especially in the institutional world, there's so much consultant gatekeeping, smoothed out valuation appraisals, all those things you've mentioned. And but from the ground level, when I look at the property sector at large today, I think some of the topics that we'll discuss are really coming to the forefront. So it's not quite easy to manage private real estate, and a lot of individuals that foray into the rentals, that dabble in the private space, find out the hard way. In fact, so many people historically have bought real estate for the in-place cash flows with not a ton of sophistication and consideration about below market rents, above market rents, and all the other capital market elements that factor into real estate. But we really are at a turning point.
That's a great point that you make, because I try to get retail investors to sometimes think like the largest institutional investors or the government, the sovereign wealth funds. Because let's use the government of Singapore, GIC, as an example. Government of Singapore is out there buying commercial real estate. They're buying properties. They're doing JV funds with some of the REITs. They're developing because they have a 50 plus year time horizon when they're out there investing. And so if you, the retail investor, can kind of put your mindset in some of what, the biggest investors in the world and what they're doing, and you don't necessarily have to have the same type of money, of course not. But if these guys are out there very opportunistic because they're seeing great values in the markets, whether it's an office or in life science or some of these other sectors, then the regular investor should kind of put themselves in that same mindset as well. Ignore the day-to-day noise and focus on the bigger picture of what's being accomplished here, as in like an apartment lease. An apartment lease is a 1-year contract. Obviously, unless you're in the market to buy a house, the renter doesn't care where interest rates are going right now. The only thing the renter cares about is what's my rent going to be this year versus next year. And if my rent goes up materially next year, what am I going to do when that time comes? but from the day to day, the movement in interest rates has really no direct impact on, let's say, bottom line operations for many of these companies. And I know we're going to talk about some of these companies coming up here, but you just kind of need to figure out, again, just keep in the back of your head, what are the smartest guys in the room, the biggest guys in the room, the biggest institutional players doing in this sector? And what's the long-term outlook for this sector, setting aside the short-term noise we're dealing with right now?
Yeah, I love that. So maybe we can, sticking with housing, just to got a couple names for you, and but not David's not necessarily even not necessarily an analyst that gives buy and help, sell recommendations, more of a news provider, and you've already explained what exactly you are, but my point is that not expecting necessarily a buy, sell, or hold. Jim Cramer, boom, what do you think about ticker symbol XYZ? Just more so putting things in context. Quantitatively, coming into this week, here, I'll show you, David, for fun here. Or, sorry. Maybe not. Yeah, forget it. There.
I see 4,000 emails in your inbox there. Boy,
yeah. This weekend we got a lot of work to do. Well, this weekend.
Oh my gosh, that would drive me crazy.
No, you're his inbox zero guy.
I'm an inbox zero guy.
Oh, dude, I wish I could be like you guys. I was like, I had an inbox zero 3 months ago, and now I'm up to 4,000. So what's the point? But anyway, so here's what I was trying to show, what I was going to show you, and I'll pull it up later. But AVB, we scored. We have a quantitative, the Swami score, right? It's voodoo, right? It's a quantitative proprietary formula that we throw against the wall, and cool, good stuff comes out. And actually, the Swami score has had I personally followed it more strictly, I would have saved myself a lot of money, right? It helps you avoid drawdowns, helps you find, it's like a fish finder for stocks, right? It just shows you, okay, here, there's some momentum, some quantitative strength here. We scored 250 tickers, ETFs, inverse ETFs, all kinds of stuff. Some in a bunch of individual stocks as well. The highest scoring of all of them, Avalon Bay. And kind of didn't have a great week, REITs in general. And so I'm just, I'm curious. One thing that Jimmy and I have, a kind of reoccurring theme that we've come back to is potentially a place to look, is these housing REITs that got hit by gateway city housing REITs, right? So I guess EQR, AVB maybe would be your
here's I have
please.
a bunch of thoughts. I got some thoughts as I'm looking at these charts here, and this is fantastic looking at this stuff.
Yeah.
And the first thing that jumps out at me is that is this equity res that we have up here right now?
EQR, yeah.
Yes. Yep.
RIP
looking at the equity res chart that you have up here right now, I see that based off of this exact point in time, we're basically right where we were when COVID started in March of 20, right around that same level.
No, so actually EQR, so we're way lower actually. So I drew this, I drew the PWL for you. So the PWL, so we came into COVID actually, and this is what's interesting, is I see this with a bunch of my personal favorite.
You're back in middle of September of 19. COVID technically started February, March of 20.
Right. So this is right here. Right.
Oh, I was looking so I was looking over, I guess, to the little bit towards the right of where you were at. Yes. Or like in between, cut the difference in between. So maybe like March, April. I'm just implying that, where we're at here is basically, and this is a great example of why of residential REITs.
Yeah.
Okay? This is stock price driven, the chart that you're showing me.
Yeah.
If you look underneath the surface of the fundamentals of what's happening with these companies, one of the great things about REITs when they do their earnings reports, and they want to highlight, because again, the stocks have been discounted so much, is we just got out of first quarter earnings season, and Jimmy knows this. We just got a first quarter earnings season, and when they do their results, they'll say our first quarter numbers versus 23 versus first quarter of 22. And oh, by the way, our first quarter numbers of 23 versus our first quarter numbers of 2019. because they're trying to say to you, hey,
Mhm.
in 2019, there was no such thing as COVID on the
Yeah.
horizon. We were at a high. Everything is going great. We're blowing away the numbers we were doing in 2019. So our stock price may not be reflecting where we were back in the heyday of 19, but the operations wise, the fundamentals wise of this company is farther way along than where we were in 2019. Our revenues are up, our occupancy is up, our dividend is up versus where we were in 2019, blah, blah, blah. And yet, look what's with our stock price right now, where our stock price is at. So
Yeah.
for me, as somebody who sits in this chair, I view this as opportunity because Equity Res, Avalon Bay, the other chart that you had up, one of the biggest markets, that one of these guys focus on is New York City. Well, we are being told that New York City is dead. The office is dead. Who wants to go back to New York? And don't take it from me, pull up any of the guys that have New York exposure. They will tell you New York City is one of the hottest apartment markets in the country right now. It is
Mhm.
literally one of the hottest rental markets in the country right now. But that doesn't make sense, right? It's almost like, wait, that makes no
Right.
sense to me. If nobody's going to the office to work and nobody's going to the corner to go shopping at H&M or whatever, why is it one of the hottest rental markets in the country? And the answer is there's only one New York City. People are going back home where they came from. And as a result, I personally think it's the first domino to fall in the recovery of New York. You draw them back in, they move in, they realize that they're not going to work out of their apartment where the bed touches 3 of the 4 walls. And they're going to realize, you know what, I'm going back to the office. And more of these New York firms are putting back in return to work, or at least 3 to 4 days a week. And so I think once you get them back in the apartments, they're going to get back into the office buildings, which will then get them back into street retail shopping, doing this, the corner shopping like they were doing before. It's just again, it's another New York cycle. New York, look at what happened after 9/11, trying to buy, lower Manhattan office or apartments. It was like throwing money down the drain. Why would anybody want to buy New York apartments, or why would anybody want to buy hotels or airlines after 9/11? And for those folks that didn't mind taking on some risk and, bad news and pain, you know, once the recovery hit a couple of years later and things got redeveloped and it regrew, that person that bought Citibank for sub $2 a share, American Airlines at $2 a share, whatever, you know, that's what they call creating generational wealth. And you had a chart of Empire State Realty up there a little while ago. That's another example of a name, thinking about like the Empire State Building, literally the most famous office building in the world that, could be, couldn't tell you what its value. Let's say it's worth $2 billion, maybe even some more than that. I don't know. But are you
Tony
worried?
Malkin wishes it was worth $2 billion.
Obviously, in today's dollars. But I mean, again,
Yes,
it's definitely a
absolutely.
very, very pricey asset. But at
Mhm.
the end of the day, this is a perfect example of the sum of the parts is greater than the whole. You know, the stock's trading at $5.96 a share. And again, I'm not saying that Empire State's a buy here, but if you buy it at $6 a share and we get this recovery and things look different 5 years from today than it does look now, and hypothetically that stock is trading at $20 a share versus $6 a share, you don't mind taking the pain today to get a 2.5, 3x return down the road once this recovers. This is a great example, by the way, because I was just at a breakfast talking about Empire State Realty, and I just saw the guys speak at the NYU conference right before Sam passed away here a couple of weeks ago. This is a great example because when you think about the return of New York City, a great proxy to see how well New York is recovering is turned towards the observatory, Empire State Building's observatory, because that tells you how many people are going to New York City for vacation, how many locals are taking their families to the Empire State Building observatory on the weekends in the springtime and the summertime. And a lot of the dividend is tied to observatories recovery. And so again, another example of talking about 23 versus 22, 23 versus 19, Empire State's basically telling you, look, here's where we were before COVID. Here's where we were when we reopened after COVID. And they're still lagging where they were at the peak, but it's a good sign of how we are recovering. Another great example to show how we are doing in the recovery process, again, not REIT specific, more higher level, is turn to Las Vegas and state of Nevada gaming numbers. what Las Vegas publishes gaming a monthly, it's basically a weekly report, but it's almost like focused on the monthly number. How many tourists are going in and out of the airport, what the take was, how the casinos did. And so this is a great proxy. Obviously, it's a great chart right there of MGM.
Yeah,
But it's a
geez.
great proxy that tells you, you know, if we're dealing with a rising interest rate environment and inflation and recession and doom and gloom and the sky is falling, then why is Las Vegas putting up unheard of revenue gains off the tables as an example? Why are these hotels seeing the amount of people coming into it that they are? And again, we don't know all about the comps and all that other stuff that
Right.
plays into it, but foot traffic is clearly up. So we are seeing a recovery underway, which is why you have a stock like Vici. I don't know if you have Vici in your system there. Like why Vici, does so well, because again, they don't own the casinos, they just own the land, and the casinos rent the land from them. That's why it was the top. Look at the chart during COVID. It got whacked at the start of COVID, and look at that performance of what happened. And the reason why that happened, this chart that you see there through COVID, is because the casinos were the only ones that were literally paying their rent every single month, even though there wasn't one person stepping foot in the Las Vegas Strip. The MGM was like, dude, the MGM grant's gonna be back. Bellagio is gonna be back. This is just a tiny blip in the radar. We're gonna pay our rent and we're gonna make things happen. And so Vici was literally the top performing stock in the REIT industry during COVID, even though none of their properties were open. So, there's great diamonds in the rough here. You just have to understand the bigger story about the why of some of these sectors. So look at, again, going back to that Avalon Bay story, they're in some very desirable markets, it's where their properties are located. Some of these markets are seeing rent growth. These guys have, again, very high occupancy. You're talking on average anywhere from like 94 to 98% occupancy for some of these guys. So if you think about that, that means there's only a handful, literally a handful of units that come up for rent into various properties every single month. So it's not like they're having to mass fill 50, 60 units at one property. They're filling 3, 4, 5 units at one property. And thus, you're getting kind of like spot market rent depending on the city and the location. But these guys are really locked in a big picture. On a high level, we have a chart in one of our decks on Armada's website that looks at national apartment occupancy going back to 2000. And I think the data came from RealPage. And it's every single apartment, public, private, Class B, Class C, mom and pop. So the entire apartment universe. And the occupancy never slipped below 90%. And so when you think about the resilience of the rental market, it's easier, obviously, to go out and rent an apartment than it is to buy a house. The housing markets are just unaffordable, and so the apartments are not going away. We know that there's supply that's coming online, but remember that the supply that comes online is replacing much, much older inventory that's frankly less desirable for the tenants that these guys are trying to garner. And so it's just another cycle of old to new. And for some of these people that are looking for new, it's going to be in these desirable locations. That's why you see, New York City constantly under development. Here in Dallas, where I'm located, SoCal, the new property will definitely transition and bring people in. And as a result, it comes at the expense of some older inventory. But in the same breath, that older inventory changes hands. It goes into a new owner's hands who puts their own spin on CapEx, attracts a new different type of clientele. And remember, all those apartment owners know what every single unit is worth in their property, the guy next door, the guy across the street, the guy a mile away. So they know what they can charge and what they can't charge, because the guy will just go looking for that better deal. So apartments go through cycles, but if you focus on the desirable markets, which is where the residential REITs are all basically located, depending on the company, we can get more into that. But if you focus on those desirable markets of where the people are going, and you give them the product that they're looking for at the price point that's comparable in the market, then you don't have to worry about occupancy. You don't have to worry about, oh my gosh, where are they going to come from? I'm a big believer of field of dreams. If you build it, they will come.
That's right.
This is a fascinating chart. I think Avalon screens a little bit better over the last decade, but you're talking about a company, and this is not total return inclusive of dividends reinvested, but you're talking about kind of near 10-year lows, right?
Yeah.
And again, where some people see risk, other people see opportunity. This is EQR in 2013, pre-Archstone, pre-New Markets, right? It's a different portfolio. Well, what is interesting is we've compared some of the different sectors and asset classes within real estate in the past, and the topic of maintenance capital expenditures comes up a lot. Like it's kind of in the forefront for office, for old retail. You know, if you were a private investor and you got into New York 10 years ago, your basis is a third of where it's at now. It's a half of where it's at now, right? Whereas your experience in these vehicles has been slightly different. You're taking on, again, different types of factor exposures, and there are times when the market's giving you a price. It's not that it's right or wrong. You just either buy, sell, or hold that price. And it's a unique time. It's almost hard to. It's funny, Auerbach. The last time that Turtle and I spoke, EQR was right at about $55. It bottom ticked one of these red wicks. But even then, the question is, after a year where interest rates skyrocketed, cap rates readjusted in the public market at least, what's built in? What are the expectations? Can you even back out of that, right? There's healthy dose of skepticism. Some people thought we were coming off, peak occupancies, peak rents, but occupancies have been tight. Rents are increasing, right? We're getting some cost pressures, but it really makes you have to dig deeper, and again, I'm not here to pitch David's product, but I think, multifamily in a sector where you have the most amount of capital markets financing, you have the most resilient and predictable demand for your asset, and you have that long-term cash flow. It's trying to get a 7% mortgage to buy a $2 million two-bedroom in New York, or buying EQR AVB at these decade lows for the next 3 to 5 year hold. It's hard to argue. And I'll my final point I'll leave you with this is, the last time we spoke, the 3-year treasury was north of 5%, and it remains north of 5% today. So, when I put on the institutional hat, other than a 1035 exchange, and I think right now, again, this is a very illiquid market where not all deals are going through, unless you have a fund that is shutting down and you have to redeploy proceeds. If you're an institution, you can park your money and wait for 3 months, for 6 months, and wait for the market to find its footing. I think that the sense of urgency is certainly not there in the same way that it was in the last decade. And if you pull up whether it's office in 2014 and 2015 with all the foreign capital, whether it's multifamily coming out of the pandemic, there were different periods where these themes became very much in vogue. But I do think that with the broader interest rate sensitivity and some of these functional obsolescence talks in broader real estate, there's been a lot of babies thrown out with the bathwater.
I would just stress that, again, every sector, every company is focused on two things: growing revenues, cutting expenses.
Mm-hmm.
And, obviously, hence growing NOI, the bottom line. And so, especially with the resi, bringing in smart technology, all this stuff on the residential side, for some of these office buildings, also instilling a lot of smart technology, smart thermostats, all that fun stuff. These guys, one thing that nobody can really control is property taxes. And that's one thing that's been weighing down a lot of folks, especially in the single family rental side, the multifamily side. Taxes and insurance has been a nice, fun thing that these guys are having to deal with, especially in this current environment. But then also think about like wintertime for the resi guys, like heating. We get several bad storms that come through, what that does, for some of the guys as far as extra heating. Or how about, hurricane season, and a hurricane comes through and wipes out a mobile, a manufactured housing park that's owned by Equity Lifestyles. So each of these sectors has their own set of challenges, obstacles to overcome. It's just, again, focusing on that big picture of what did management learn from the last cycle? How do we not make the same mistakes again when we're presented with a certain opportunity? What do we learn from the last time that'll help us move forward this time around? We could spend all the time that's focusing on, Avalon Equity Res. I want to talk about some other stuff there. Let's change sectors.
I love it.
Yeah.
Love it. The close. So no, I think here I'll close the door on the housing related REITs with this quote from Macro Voices from I think about 3 or 4 weeks ago. Townsend said this. That was great show. If you don't watch Macro, or if you don't listen to Macro Voices, it's a good macro podcast to throw into the lineup. But he says he says something, paraphrasing here. He says the back half of this year brings the long-awaited recession everyone's been talking about, which brings a generational buying opportunity in copper, uranium, and oil. We're not here to talk about any of those things here today. I think that what would be so interesting. Let's just end this. David, what doesn't want to see this chart anymore? But one last thing here on this is so like, coming into so you got the end of 2019, 2000. So for the viewers at home, we're calling late February, the peak of the market. We're calling the PWL, the pre-Wu flu level. TM to Dr. Jin on Twitter, great follow. And then the COVID lows. And so the point is, those two names we mentioned, AVB, EQR, specifically, much closer to their COVID lows and COVID highs. But you can find a bunch of blue chip REITs. When it comes to real estate, let's say one more thing on REITs broadly is, there's 3 of us here on the show, 2 black belts and a literal white belt. Like I'm just a guy here, just trying, I'm learning about real estate investment trusts from these black belts. So that's where I sit on this panel here. But what I would consider these blue chip REITs much closer to their COVID lows. Like remember how uncertain the future was in end of March 2020 compared to today. And so so what Townsend said about generational buying opportunities in certain commodities, maybe maybe these publicly traded REITs, especially the blue chip ones, it's like, give me the COVID lows, baby. Let's go.
Well, I just want to touch on before we go on, just remember that regardless of rising interest rates, regardless of inflation, recession, economic cycle, whatever you want to call it, we're still going to Starbucks and getting that cup of coffee. We're still going to Walgreens and getting that prescription. We're still going to the grocery store and buying groceries. We're still doing Zoom conversations, benefiting tower REITs. We're still ordering packages from Amazon through our cell phones. We're using REIT-owned properties every single day of our lives, 24/7. And so this is not going away, regardless of what's happening with federal funds, interest rates, people's bank accounts. We're still living our lives in a REIT-owned universe.
Well, let me ask you about that, because I guess, again, as the white belt on the show, tell me how, because here's the one thing that helped me with this. The cost of capital going up so much changes the business model slightly, yes, or not slightly, changes the business model maybe significantly, yes or no, to the black belts on the panel.
David, do you want to start?
Yeah, I would say that
Sure.
that's at this moment in time a misconception. And the reason being because these REITs refinanced their balance sheets to the tune of hundreds of billions of dollars during COVID, that they are so well capitalized that I feel like they don't necessarily care that we're in a 5.25% interest rate environment, because they locked it down when the 10-year was trading at 1.5% versus 3.80. That's just my take on it, Jimmy.
Yeah, no, good.
Yeah, I think obviously it matters more to some company than others. We've talked about how triple net leases or triple net REITs historically have had a premium cost of capital versus the private market. And I would say today it's still largely true. Whether the private market's taken that mark, as far as external growth, there's REITs that definitely need a lower cost of capital to get more accretion. But even as interest rates rise, if you're a mom and pop out parcel and your access to capital is limited, that spread still remains. But again, we've done the math, right? If your cost of capital is a 7 and you're acquiring at a 10, that's a different level of accretion on a percentage basis than if your cost of capital is a 3 and you're acquiring at a 5. And so, really the phenomenon, even coming into COVID and for the several years before, where interest rates really rock bottomed and we were living in this ZERP type of scenario, was fantastic for a lot of real estate. I'd say today, still it's hard when we look at implied cap rates and we see REITs trading at a discount to what might be a stale NAV, but something that has some historical precedence. If you're able to collect over 5% unlevered cash flow risk-free from the government today, what is the impetus to pay a 5% cap rate for a REIT or even a piece of private real estate, where after capital expenditures, after G&A, your unlevered cash flow yield is likely to be south of that. I think today that gets the incremental person out or keeps them on the sidelines. But when I look at really just the interest rate sensitivity, I mean, David's absolutely right. These companies have well-laddered maturities. They have access to some of the best forms of capital if needed, and I don't think it's a day-to-day concern. I don't think it drives their operations. It's still very much, block by block. It's fundamental.
From a high level, we did a blog on our website where we took our top 10 constituents, analyzed their debt stacks, and at the end of the day, our conclusion was they have a weighted average maturity of like 8 years and change at a weighted average coupon of like 3.6%, which was right in line with where the 10-year Treasury was when we did our analysis a couple of months ago. More importantly, the 10-year Treasuries, as you had that chart for a while, it had been in a tight band for a long time over the past several months. And so if our average debt stack is right in line with where the 10-year Treasury is, again, it shows you that their pricing is basically tight with the market right now. And I don't know what tomorrow presents. We just got to focus on the here and now. And I think that these guys are just focused on operations. That's the CFO's job, is to figure out, well, we've got debt coming due in 24. What do we pull the trigger on that? Do we wait until we start cutting? Do we do something now? Do we, blend and extend? That's the stuff that they're having to sit there and have these conversations, think about. But on average, there's very little debt that has to be faced within the next year or so, or 2 years.
And Dave, you and I, we've done that institutional dance. I think coming into 2023, seeing how REITs performed, when you look at the sell side and what they have to do, everyone, moves their models in arrears after the fact. When you have low in-place cost of debt and laddered maturities, there's some consideration that, hey, you're going to have some FFO drag for the next several years as rates ratchet higher for every year. But again, a lot of that is narrative. It is a reality, but the movement right now can be, I think, still is very much explained by just bond volatility.
You talk about narrative, and I want to shift gears because I think one of the things that Turtle wanted to talk about, not to fast forward, was like Empire State Realty leasing in New York this week. And wasn't that one of the things you wanted to touch upon, was the big Empire State lease with Flagstar this week?
Yeah, let's talk about it. Yeah, it was the
let's talk about it.
Yeah, I think the two other clips. So there's 3 things from Daily REIT Beat this week. Maybe we can hit on them in 15 minutes. If not, we'll have you back on and talk about it next time. Empire State.
Let's do it.
Empire State news, MPW news, and then the land and buildings guy, short the JB Smith.
Well, we could combine the John Litt with the Empire State news. And also, I want to talk about Sanzell. We should address Sanzell.
Yeah, love it.
All right. Empire State's an interesting story this week because they announced a 300,000 foot Flagstar Bank was taking over Silicon Valley Bank's lease. Was it Silicon Valley Bank? Yeah, Silicon Valley Bank's lease at was it on Broadway? I believe was one of the transactions. They also signed I think it was a 30,000 foot lease at 1333 Broadway with a nonprofit called Rising Ground this week. So it's an interesting signal. Forget all the stuff we were talking about before about New York occupancy, residential. If things are that bad in New York, they had no problem turning around 300,000 square feet of a big block of space to fill, and they were able to backfill it. And SL Green is very busy doing the development and leasing of, One Madison, following on the success of One Vanderbilt. Now, we know obviously the newest property will draw the tenants in. It may not necessarily make the occupancy, physical in-person occupancy versus building occupancy, but it seems like there's a couple of signals out there that they're, again, go back to SL Green's first quarter earnings results, and the amount of leasing that they had accomplished in the first quarter. They were, and the in-place rent, granted the mark on the current lease versus the old lease, is a different time. But then you have John Litt on the other side, land and building, whose name came up at my breakfast this morning from a guy from Dallas. Like, have you heard of this guy named John Litt? And of course, we all know who John Litt is in our business. Yeah. But John Litt came out this week on CNBC. He was interviewed on Fast Money after the close one evening, the last guest. And he talked about now how he's short JBG Smith in DC. Plus, on top of his bigger office reach short from New York and everything. And if I recall, he's based in Stamford, Connecticut. So, he does see it in his own backyard. And John, during COVID, coming out of COVID, let's say end to 21, 22, he was basically going out doing interviews and talking about how the office REITs are trying to survive to 25. That was his pitch, survive to 25. And we don't know how many of these guys are going to survive to 25. Or, I think we're going to be seeing some consolidation in the space. In my opinion, this is just my opinion, I'm not making a recommendation, but I would not be shocked if we see a merger agreement between an SL Green, a Vornado, and a Boston Properties, two of those three companies combining in some form or fashion. The one that I would expect the most would be SL Green and Vornado to get together. Again, I don't have any proof, I have no information, but it would not shock me if, based off of where the current stocks and stories are, it would make sense at this point, I think, for them to get together to try to survive together and build towards the future.
So when did John Litt short JBG Smith on this chart? Do you know? Was it after the move? Was it around that $20 mark? I guess that was the beginning of the year, but he came out recently.
My gut tells me it was a 23 name, right? I would 23. Say my guess is somewhere in that end of 22 into 23 where those two red bars are. That's just my guess.
Sure.
But I know that he's been short SL Green, Vornado, and of course, again, like, no disrespect to John, but gee, wow, like, way to really get out there during COVID and say short New York office. Like, everybody does well when things are going up, and everybody looks smart when things are going down, and you say it's going down. I mean, again, I'm not disrespecting John. I do think he has something about the survive to 25. But again, I think it goes back to some of the stuff I was talking about earlier, because there are certain signs that are out there, whether it's Placer.ai, Castle Systems, some of these other foot traffic analyzers, but there are some signals that some foot traffic is picking up in New York and some of these other markets. Secondarily, I think a bigger story here that's not being reflected in this chart of Empire State or any of this other ones that we talked about is suburban office, because we are still seeing the demand for that suburban office space, especially in some of the, closer to the New York area. I mean, again, me in Texas, everything is suburban office, basically, where you have guys like Highwoods and, City Office, which has just been beaten up, but the occupancy story remains pretty strong for them because, again, the suburbs, you'd much rather go down the street than have to hop on the train and go downtown. So I feel like, so we're talking about, misinformed misconceptions. Office isn't dead. The office use has changed dramatically, but there's still some good stories that are out there. Piedmont's another good example, PDM, where you have some of these suburban Sunbelt market players that are focusing on, the top properties in the suburbs that people are going to. Now, I was chatting with somebody in a very desirable office building here in town in one of the suburbs, and he commented to me that, there used to be 1,200 people that would be in the building every single day. The building was like 80% physical occupancy, and now it's like 50%. And I said, I don't think it's necessarily going to go back to 80+% physically occupied, but you may have the hybrid workforce where they, might utilize some of that. But I think, we've all realized that work from home is here to stay in some form or fashion. I mean, Jimmy, I don't know if you were on the street long enough, but I mean, back in my day, back at Green Street, and all these other firms, we used to have disaster recovery offices because of what had happened. We would have literally a second physical office location set up that was never used, but in the event of an emergency or a disaster, we would go to this remote location and be up and running. Well, COVID has proven that we don't need disaster recovery offices anymore. So there goes a bunch of office inventory because now everything is being done by a laptop. We don't even need to go have that secondary office.
You're absolutely right. Yep.
Yeah, I just think that, I think an office is going to come back. I think New York office is going to evolve. Sure, a lot of those buildings that exist now will not be, in the same owner's hands once this cycle ends. But, if you think we're about to start closing the Empire State Building and One Vanderbilt and some of these other properties, I mean, I'll go ahead and say it. You're crazy. That's not going to happen. That's just, I can't use the word guarantee because we're not allowed to use the word guarantee, but I guarantee that's not about to happen in the near future.
I'll qualify my long-term optimism for real estate by saying that all these charts we've seen, they look awful.
I was going to say that too.
And for a lot of these companies, it's been quite the fall from grace. A company like Highwoods, which for over a decade always had a premium. They were a fantastic operator. They run their suburban office properties, unlike a lot of other suburban assets. Turtle, you and I, we keep going back to this, that within the real estate crowd, and the real estate as a subsector is a lot more, even with all the incremental generalists, the hedge funds, the momentum traders. You've always had that REIT mafia. You've always had that long-term dedicated capital, but I think it's also created a certain type of mindset where you have relative valuations matter, absolute valuations matter, spread to triple B yield, spread to all these different considerations that people have seen forever. And we're in a time when we don't have high quality transactional comparables, and we really don't know what the cap rate is. And we hear all the stories of CapEx and blah, 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 and you have leverage, right? 30-40% leverage, debt to market cap at NAV sounds great, but when you're trading at a discount, all of a sudden you start looking at 50-60% leverage. So
Jimmy,
in the case
if we were in a Twitter Spaces event, I'd be hitting the 100 button. I'd be doing the applause thing right now because you nailed it. That's the key here. That's the thing that nobody understands. There's no effing transactions happening.
None.
So you can't get a price point. You don't know what the cap rate is because nothing is changing hands. Everything that's happening right now is really based on assumptions. You know what they say about people who assume, right, Turtle? Have you ever heard that expression, what they say about people who assume?
Yeah. They make an ass out of you and me.
Exactly. Like thank you. So, Jimmy, you bring up a fantastic point that the only sector that we have a price point bogey to focus on right now is self-storage because of the merger between life storage and extra space. That's the only sector right now.
And look at those comps, right? Look at that confidence that the buyers have in the long-term trajectory of that business.
It's the only sector that truly has a place to comp something right now with the price. So something interesting to follow. I look forward to having this conversation a year from now to see where office is a year from now and if anything has changed.
I love
it. Let's talk about medical properties.
Let's talk about it. So there was a transaction, right? And that's what's interesting about it. MPW, for those who've been living under a rock or maybe just don't follow the REIT happenings as much as my two co-hosts here. MPW is the story in REIT land. And it's definitely had the fall from grace. If you're looking for some hard-hitting drama, you could turn on Real Housewives, or you could go to Seeking Alpha comment section on MPW, and this is way more hard-hitting, guys. I mean, there are battles going on in the comment section. So the stock has dropped like a rock from 20 to 8. And the question is from here, so the question is, back to kind of the topic of the show, generational buying opportunity, or am I buying a can of rotten sardines? to you, David. No, I'm just kidding. But no, there was a transaction there this week in Australia. The Bulls are saying it justifies management's case. The Bulls are saying that now we have cap rates to go off of these other assets that the plundering short sellers or whatever, you know, the short and distort sellers, who personally I respect very much, none more than Rob Simone. Hedge Eye is kind of the main bad guy on the Seeking Alpha comments. Great guy, friend of the show. Pointing to me. So the question to you is, what do you think was clarified by this transaction, and what happens next? I'd love to hear both your takes on it.
So first of all, hello to Rob, because he's a personal buddy of mine as well. We just talked earlier this week. In fact, I was also with Brad Thomas of Seeking Alpha this week in Florida, the other side of it. And so personally, I don't have a horse in the game. I don't own the name. I operate from a very high level. And so I just want to say that I don't have a vested interest in the story. I will say, Jimmy, unless I missed something, does a transaction in Australia have anything to do with cap rates here in the States?
Or U.S. reimbursement policies?
Does what's happening in Australia property operations have anything to do with what's happening here in the United States? Like, I read the press release that they put out, and I almost chuckled when I saw that, because, like, how do you use something in Australia as the proxy for what's happening here domestically? That's like comical, if you ask me. Here's where I focus. The bottom line. If they're all about reducing leverage and reducing debt, then that was a good transaction, because you need to get your leverage under control. More importantly, the issue here is the dividend coverage, because from what I understand, they are not covering their dividend based off of current operations. But then there's a bigger picture here. You have a CEO, a CFO, a C-suite team, a board of directors responding to shareholders, representing shareholder dollars. And I see that chart, and as a shareholder, I would be very unhappy, because the only people that are making money off of this right now is management. Now, granted, management's taken a hit in their compensation because they've seen the stock go from 20 to 8, but they're not losing sleep at night because of what they have in the bank. I have the utmost respect for Rob and the work that he's done on this. And I know that there's bulls out there that will live and die on the sword on this particular example. And I'm sad to say, but I think medical properties has become the new meme stock of the REIT industry, similar to what Ashford Hospitality was during COVID as a meme stock, and that it doesn't take much to move the needle for it to have a roller coaster ride. And as a REIT industry expert who focuses on the transparency of management teams, I personally feel that medical properties has not done a very good job of controlling the narrative as trying to explain to shareholders why, you know, whether Rob is right or wrong, and that's a different conversation, not for this platform, but management has not done a good job of addressing the points that Rob and others have raised to try to control this narrative and turn around this bloodbath, in my opinion. And all you got to do is address the facts, focus on the operations, grow the bottom line. And if this Australia transaction, lowering their leverage, the debt, is the first step in fixing that narrative, that's great. However, there's a track record here, and management has a very poor track record of communication and transparency. And so I feel like until they're able to shape that a little bit better, I think this is going to work more in the Bears camp for the long haul than it is going to be for the Bulls camp. That's just my take. Jimmy?
Yeah, I think those are good points. I'll add to it and say that I had a chance to meet the management team pretty early in my career. So this is probably over 10 years ago, when the stock was at about $8. One of the things that I think is finally coming to the forefront with some of Rob's work and some of the more deep dives into this, you know, the healthcare sector but when it comes to hospital systems, is just the complexity of it. You know, when I covered healthcare as a REIT analyst, this is a sector that has, you know, 4 or 5 subsectors. There's so much, you know, fundamental complexity in the business models and where they get their revenues from and how the leases are structured. You know, we need to keep it simple. And in a bull market, when you can talk about narratives and lease coverage, it works until it doesn't. You know, this is a very, very tricky thing. If you look at Ventas, if you look at the rest of the healthcare space, you know, really since 2017, 2018, there was a period of time when interest rates started to come down, and we saw that cap rate compression from what had historically been much riskier sectors. You look at skilled nursing facilities, you look at hospitals, you look at, you know, just these were 10 cap properties that could not get a lot of financing because there were big ticket purchases. There was a lot of, you know, reimbursement risk, and some of our viewers know this from before. But you know, when NNN or when Realty Income, when they structure a lease, you're backing into an unlevered cash flow yield that gives the underlying tenant some breathing room. So depending on the fundamental business of the tenant, you know, if you have a fat gross margin and a fat EBITDA margin, the tenant can absorb some volatility, and you can squeeze more rent out of the tenant in order to 1035 their property and give them that capital on day one. When you have an asset class that requires a ton of capital to run, that structurally does a lot of pro bono work, has a lot of lower margins, and you start compressing the yield, right? You're willing to take a lower price, and you're putting in an in-place coverage that looks good during a bull market. When that starts to wear thin, if you are running a 10% gross margin business and your revenues go down by 5%, things get kind of hairy. And if you can't cut costs, all of a sudden, you know, that 1.1x rent coverage goes down to 0.9 really quickly. And so there's a reason why historically, when hospital deals are done, they were done with 3x four-wall coverage, 4x four-wall coverage, and they were still, you know, only getting a 10% cap rate on those transactions. So there's a lot of margin of safety that was built in that was gradually eroded towards the end of this cycle. And here we find ourselves in 2023, where, you know, the in-place cap rate for the portfolio, where the market used to value the properties, versus the underlying issues that are now coming to the forefront. There's no way for an average mom and pop, you know, Joe, to wrap their heads around that. And so the dividend is really at risk. The business model is at risk. They need a premium cost of capital. And when the management is not very forthright about that, when they try to discount some of these things, you know, it's a long road to rebuild that institutional trust that gives them the capital to go out and do their business model.
I
Man,
will say from a high level though, love hospitals, love medical office. This is a sector that, you know, is only going to continue to grow more and more, especially as the population ages more and more. Medical office development is a very hot sector right now. And
Of
so
course.
if you think about the hospital plus medical office combo that happens hand in hand, from a very high level, love the story of the sector as a whole, but there's probably better ways to play it. Like I like Physicians Realty Trust personally. I like DOC, DOC. If you're going to play medical office, I would personally rather own DOC, just because cleaner management team,
how
cleaner
many jets do they
story.
have?
No jets that I'm aware of.
I like jets. I like a management team that likes to fly around private.
They're not offering me any flights. I'm not getting the you know, the Succession type of treatment like they are.
Mhm.
So yeah. I'm not getting the Roy family treatment, unfortunately, on the jet.
Man, guys, I couldn't ask for, that's a great chair. You guys
Real
put a
quick,
beautiful cherry on the Sunday.
real quick.
Please.
Let's talk about Samsung. We
Yeah.
wouldn't be here if it
Yeah,
wasn't for Sam. We wouldn't
absolutely,
be
dude.
here.
Absolutely.
Jimmy and I would not be in the position that we're in if it wasn't for
Yeah.
somebody like Sam Zell.
Yeah.
I saw him speak just a couple of weeks ago at his last conference at NYU. He was pistol, and you know, I'm very sad still to this day, because you know, he is an industry heavyweight. For those that like to read, his autobiography is fantastic. There's another book written by Ken Campbell several years ago called Watch Out for That Rat Hole. And it's a history of the REIT industry. Covers basically the birth of the REIT industry. And it's got Sam all over it, as you can imagine. But, we are sitting here talking about a sector that Sam built. We're talking about a sector that Sam, I like to educate, and the biggest educator of any of them in this industry was Sam Zell. Nobody in this industry has the personality and, frankly, the weight that he did. And it's amazing because, he wasn't the tallest man in the world. He wasn't the strongest guy in the world, but dude, he carried such a loud, powerful voice in his frame that, every single one of us owes a debt of gratitude for Sam and everything that he did to help us get to where the REIT industry is today. And, I don't know anybody personally out there that will be able to fill the shoes like he did for so many years. And so we should all, regardless of when you're listening to this, just take a step back and think about where we are in this REIT industry today and how we got here. And it was all because, frankly, at the end of the day, because his Sam and the REIT Mafia and all of these guys got together to really put this industry on the map.
Well said, David. Turtle and I, we covered Am I Being Too Subtle a couple of episodes back. And, like yourself, I had a chance to meet him several years ago when he was on the press tour for that. I mean, he really epitomized the sector, but in terms of being an operator, being a financier, working both sides, just understanding the capital market and then understanding the fundamentals of his businesses, truly larger than life, right? And he never, he was never unavailable. He's an everyman, right? He's the guy that you can get a beer with and shoot the shit and talk, have a real conversation. Just incredible.
And for anybody that's watching this, definitely, because I think that Harvard did a case study on it, but go review the Equity Office, Rexon, SL Green, Blackstone bidding process back in the day and how he sold EOP. And I mean, it's one of the best stories from my REIT career, just watching all of that unfold. So let's dedicate this particular episode to Sam. Let's go out there, kick ass, and take names like Sam would. Let's all get on the back of our Harleys, smoke our Marlboro Reds, and live like, we own the joint.
That's right.
That's right. That is right. Beautiful way to end it. Really appreciate you bringing up the Sam Zell thing. You've been a great guest, David. We really appreciate you. Jimmy, thank you for your time as always as well. Learned a lot. I really think the big takeaway is that, back to the generational, there's babies potentially being thrown out here with bathwater. You look at these different charts, you see a lot of, there's pain in certain sectors. And some of these brands and, a lot of these brands will survive and persevere and being able to, doing your homework and figuring out which sardines, which package of sardines you want to buy is I think, there's ample things to sort through here. Back to here's what I want to show you before, David, no big deal, but here's our coming into the week. AVB was our strongest single individual ticker out of 250 we track. Here's all our bunch of top tickers. But it doesn't mean we're going to buy all this stuff. This is just like quantitatively. This is what the fish finder says the fish are. So I think Stag's in there. So industrial.
Where's I see homes. Where's house?
Oh, so that's we're getting that added to the model. It's in the model now. Didn't come out on that one. And by the way, you bring it up. Not like I wasn't going to bring it up anyway, but we have a Swami daily ETF report. You can come in here and get free signals on a strength of signal on 250 tickers. And guess what? We have a specific REIT dedicated page. Here's the top 25 holdings from XLRE, and we'll give you a strength of signal on all of them every day. AVB recently broke trend, lost some signal strength, but it looks good. Eventually, we'll give you a trend level. If we can get back above trend, that's a great, that could be a beautiful pony to ride back up if this thing's heading back towards the surface. So so check that out. But more than anything, guys, thank you very much. Make sure and check out do your own due diligence. But HAUS is a very, very interesting ETF. Jimmy and I pretty much we bring it up every sector is at least or every time we do a show, just at least as a canary to watch. And I really think we're getting close to that potential maybe generational disconnect, at least between private and public. But I really think there's some buying opportunities out there. So with that, any closing comments, fellas?
Yeah,
or,
I can't wait to do this in a couple of weeks when we have more to talk about.
Let's go.
Some
Absolutely. Absolutely,
we'll
guys.
We'll love that. Cool, guys. Have a great Memorial Day weekend. I echo Jamie and David's thoughts at the beginning. Enjoy it. And thanks for watching Real Assets Weekly. And definitely have a great Memorial Day, guys.
Been a pleasure.
Thanks, Charles.